Now, the part of the show where we talk about three ideas that individual investors should be focusing on or keep in the back of their minds before they make their investment decisions. And here are our three topics for this show. Corporate earnings. We're now entering into the corporate earnings season. We've pretty much seen most of the big banks in the United States report earnings, and they've pretty much all been blowout earnings. They've all performed extremely well, beating expectations, top, bottom line. Everything's been going quite smoothly up until now. Second, valuation stretched. We talk about valuations of the stock market quite often, and a lot of people talking about this time valuations, the S&P 500 trading above norms, so slightly overvalued perhaps. And our third point, geopolitical concerns. These are all, unfortunately, in the back of our minds, what's going on in the Middle East, what's going on Russia, Ukraine, and anywhere else in the world. A lot of rumblings out of China, what the relationship between China and the US, at times okay, at times not so good. So we have to keep an eye on all these things, and definitely something that I wanted to touch on for our show today. So let's get to our first one, corporate earnings. As I mentioned, we are in corporate earnings season, just started with the main US banks reporting. And as I said, unbelievable results. JP Morgan, Wells Fargo, Citibank, Bank of America, Goldman Sachs, and as early as or as recent as this morning, Morgan Stanley, all reporting great earnings. They're seeing investment banking doing well, net interest margins, so the spread between what they lend money at and charge and what they pay on their savings accounts and GICs, that spread, we call it net interest margin, doing well at most of the banks. Even though JP Morgan said it wasn't going to look as strong, they actually came in with pretty good results. Trading was good at all these banks, especially Morgan Stanley this morning. Wealth management fees are going up. Whenever the market goes up, remember, a lot of these accounts pay a flat fee for the year, and it's based as a percentage of the investments. And as the investments rise, so do the fees, so do the costs of managing those portfolios. So any of these wealth management fees, they're going up at the banks as well. So the bank's really making a fantastic run this past quarter, and we've seen their stock prices moving in tandem with the results. So a couple of charts we have to start off. Let's look at the biggest bank in North America, one of the biggest banks in the world, JP Morgan. And we have a chart of JP Morgan here. There you go. It came down a little bit, but has now recently surged back to all-time highs. We have a chart, next chart here, Wells Fargo as well. You can see a nice run up on the far right-hand side of that chart. Wells Fargo making a great run. Wells Fargo, arguably the third largest bank in the United States, just after Bank of America, probably just before Citibank as well. Now, earnings season, you could say, okay, well, that's the banks. But for many people, and with the S&P 500 being 50% pretty much technology, the earnings season, for some, they'll say, well, the earnings season doesn't start until we get tech earnings. And that could be a good point. And that happens all next week. We're going to get Tesla earnings. We're going to get Google earnings shortly after. Following week, we're going to start to get more of the Mag 7, Amazon, and other names reporting. And we know how crucial the Mag 7 is to, I guess, overall investors' returns, to the stock market in general. We have a chart on the Mag 7 that we can show. There it is. You can see there have been a bit of a few blips in the last few months with respect to, is there a slowdown in the overall economy? Is there a slowdown with some of these tech names? But you could see any blip down has been bought quite strongly, actually. And you can see that the Mag 7 perhaps not at its all-time high. That was reached sometime in the summer, July, August timeframe, but still very, very strong. And as I tell people, I still believe, yes, even though the market breadth has widened, even though there are a lot more names participating in the rally, I still believe you need to own technology. And one stock chart that I wanted to put up here with respect to earnings season, that's Taiwan Semiconductor. And that's a name that a lot of people don't talk about, a name that I don't talk much about on our show. Taiwan Semiconductor, global chip maker. NVIDIA is their client, amongst other companies as well. And it's a name that is doing phenomenally well. with artificial intelligence booming, chip making booming. Taiwan Semiconductor is a chip maker, and they're doing extremely well. They report earnings tomorrow, actually. And with a chip maker in Europe reporting yesterday, reported earnings that weren't so great. Chip makers all over the world sold off a little bit. If Taiwan Semi reports strong earnings, which I believe they will, we could see a resurgence in some of these tech names once again, like NVIDIA, AMD, and many others. So Taiwan Semi, I wanted to put that up today as a name to keep an eye on. Reporting earnings tomorrow. I'm hopeful that they will be great. So overall, I think you need to keep one eye, or if not both eyes, on corporate earnings season, especially as we get into the tech names. Second topic that I wanted to discuss, valuations stretched. And it's interesting because, and actually we can show the S&P 500 chart. We can put that up as I speak. But the S&P 500, a lot of people talk about, well, yes, the S&P 500, there it is doing so well, but that's on the back of these Mag 7, Magnificent 7 stocks, the big cap tech names, because they are such a large component of the S&P 500. It's no wonder that the S&P 500 is doing as well. And if you factor out those names, then the market actually is not expensive and it's not, valuations are not stretched. Well, don't know if that's so true anymore. So here's the S&P 500, and you can see how well it's doing. Now, if I were to show you an equal weighted S&P 500, so that means not overvaluing or looking at these names, that the biggest tech names, and how much they make of the S&P 500, how much of a component to the S&P 500 these 7 names make. If you took everything and equal weighted it, what would the S&P 500 be doing? Well, here you have it, S&P 500 equal weight index, and it's still way up and up quite a bit. So does that tell us that valuations are okay? No, I think for many names, valuations are a little bit stretched, and you have to be mindful of that. You can't just go ahead and chase your favorite tech stock, your bank stock, pharmaceutical stock, or oil stock, or whatever company you're looking at. You have to look at valuations, and valuation is extremely important. Our next chart here, you can see PE ratios, how high PE ratios have surged. You can see the colored area there is more of a normal area, or what we would call normal range for PEs. And you can see how much PEs are stretched. So overall, to me, I think stretched valuations is something that individual investors need to consider before they make their investment decisions. Our third and final point for today, geopolitical tensions, geopolitical concerns. In particular, what's going on in the Middle East. Obviously, we've seen a lot of back and forth between Israel, Hezbollah, Hamas, and Iran. Iran recently sent in, I think it was something like 200 missiles into Israel at the beginning of October. And, what did that do to the market? These geopolitical concerns can definitely cause the markets to pull back. They can cause the markets to have a difficult time. First chart I wanted to show, actually, we can show the S&P 500 index. We can show the Iran missile attack and what it did to the markets on that day. And there it is. So you can see Iran missile attack on Israel was the beginning of October, and you saw a gradual, leading to the beginning of October, a gradual upward, upward slope of the market. And then Iran sent those missiles into Israel, and you can see how quickly the market sold off. And it wasn't until, I would say, sometime around maybe after the first week of October, did things start to pick back up again. So these geopolitical tensions, concerns, they can cause the markets to definitely do different things, sell off, unfortunately. And we also saw WTI, oil, and how the effects of oil and what's been happening there. So let's put up a chart on oil, and you'll see that when the tension started in the Middle East, oil shot up, which makes sense, right? Iran's a big producer of oil. There was talk that Israel would retaliate and take out some of their nuclear facilities, some of their oil refineries. And so because of that, price of oil shot higher. Well, in the last couple of days, for some reason, I'm not sure, some information was leaked. And it seems that Israel has said that they will not attack those areas of Iran, and instead they may go after other facilities, perhaps. So we're now seeing the effects of that. Price of oil shot up to quite high, maybe in the mid to high 70s, and now it's pulled back just above $70 a barrel on the news that no, Israel may not attack the refineries and attack the oil infrastructure of Iran. So you can see how volatile geopolitical concerns and risks can be to the market, to people's portfolios, and definitely something to consider with the other two topics as well before you make your investment decisions over the next 10 days.